Stop. Before you read another headline or check another price today, I need you to understand what February 22nd, 2026 actually means for this market. I know some of you felt the doubt creeping back midweek when silver pulled off its Friday highs. I know the feeling. One big session, half a session back, and suddenly the bears are loud again. They are wrong. Sunday, February 22nd, 2026, and silver has just posted its third consecutive daily advance, closing the week at $82.34 on COMEX. A gain of $4.38, a 5.62% weekly move. That is not a speculative spike. That is a market laying structural bricks. Ladies and gentlemen, analyst here, the safe haven clock is running, and the forces driving this move are not temporary. They are accelerating. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let me decode the anatomy of this week's price action, phase by phase. Because what happened between February 20th and 22nd carries a specific structural message about what happens next. Silver entered the week with momentum from the prior Friday's dramatic surge, but faced an immediate test. Would buyers maintain conviction when the dollar began recovering and the initial geopolitical adrenaline faded? The answer was 3 consecutive sessions of positive closes. Reports confirmed silver was trading near $82.80 on Friday, marking its third straight advancing session, and positioning the metal for a weekly gain of more than 5%. Analysts note that the advance came despite a broadly stronger US dollar, a detail that separates this rally from a simple currency trade. When silver advances against dollar headwinds, the buyer is not a currency speculator. The buyer is a conviction holder. Sources confirm the COMEX weekly close at $82.34, a gain of $4.38 or 5.62% on the week. This is not a partial recovery. This is a new weekly closing floor above $82. Every week that ends above 82 reinforces the base from which the next leg higher launches. Now let me lay out the technical anatomy in plain terms. Think of the market's volatility envelope as walls and ceilings that shift with price momentum. The upper boundary of this envelope, of the ceiling that price must pierce to signal expansion, was sitting at $82.39 heading into Friday, according to analyst tracking. Silver has now pressed above that level and is attempting to sustain its close there. When price closes above its own volatility ceiling on a weekly basis, the market is communicating one thing: buying pressure has overwhelmed the expected range. That is a structural expansion signal. Above the current level, the next resistance wall stands at $86. That is the first battle position for the week ahead. Above 86, the next fortress is at $92. The outer boundary of the neckline zone for the broader inverse head and shoulders pattern that has been constructing since the January 29th all-time high. 92 is not just a technical number. It is the level where the full measured move of the pattern activates, and the structural target of 104 comes into direct range. On the downside, because an honest battle plan always accounts for retreat, the first defensive line is the 20-period moving average at $77.34. Analysts note that a decisive break below this level would expose the next support at $72.16, followed by the confirmed February swing low at $64. That $64 floor has held since early February. It is the structural anchor of the right shoulder base. The bull structure remains intact above 77. The tactical entry zone for new positions on any pullback is the $77 to $78 range. The path from current price at 82 to the neckline activation at 92 is 11%. A market that delivered 5.62% in a single week has the velocity to cover 11% in 2 weeks if the catalysts sustain. The catalysts are active. The structure is sound. The neckline is in sight. Now let me reveal the 3-layer fundamental engine operating beneath this market. Because the safe haven bid that pushed silver to an $82 weekly close is not built on emotion. It is built on 3 concrete and simultaneous structural forces. Layer 1, the Iran military standoff. Reports confirm that as of the weekend of February 22nd, 2026, 2 U.S. aircraft carrier groups were positioned near the Middle East, the Abraham Lincoln already in the region and the Gerald Ford en route, with reports indicating the U.S. military was prepared for potential action as early as that weekend pending a final presidential decision. Nuclear negotiations, conducted through Oman and Geneva, produced what Tehran described as a general framework agreement, but sources confirm that VP J.D. Vance publicly declared Iran had failed to meet the administration's core red lines. A 4-point Israeli demand framework documented in assessments published February 22nd calls for complete dismantlement of Iran's enrichment infrastructure, ballistic missiles, restricted to a range no greater than 300 kilometers, full termination of proxy financing networks, and an end to the violent suppression of Iranian civilians. None of these four demands have been acknowledged as acceptable by Tehran. The gap between the U.S.-Israeli position and Iran's red lines is not narrowing on the timeline that silver's price action requires for resolution. The standoff continues. The safe haven premium holds. The stakes of this standoff for silver are direct and physical. Reports confirm that 20 million barrels of crude oil transit the Strait of Hormuz every single day, representing 20% of total global oil consumption. A military exchange anywhere near that choke point does not stay inside the choke point. It enters every energy-intensive supply chain in the world simultaneously. Silver is smelted, refined, transported, and fabricated using energy at every stage. A Hormuz disruption scenario does not simply add an Iran war premium to silver's price. It adds an energy cost shock to the entire production pipeline of the metal at the same moment that safe haven buyers are flooding into it. That is a double compression from both the supply and demand side simultaneously. Layer 2, the tariff volatility trap. Reports confirm the dollar initially fell to approximately 97.8 on the SCOTUS tariff ruling, then recovered as the White House imposed a fresh 10% global tariff through executive order, subsequently announcing an increase to 15%. The net result is a dollar that moved sharply down, sharply back, and is now trading in a zone of structural ambiguity. Analysts note that the tariff policy environment has revived trade uncertainties and strengthened safe haven demand, specifically because investors cannot anchor their dollar assumptions to a stable policy baseline. When the reserve currency's value is a function of executive orders issued in real time, hard assets become the only reliable store of value. Silver absorbs that uncertainty in its price. Layer 3, China's refined silver export wall. Sources confirm that from January 1st, 2026, China, controlling between 60 and 70% of the world's refined silver supply, implemented export licensing requirements, restricting exports exclusively to state-approved companies with minimum annual capacity of 80 tons and government-issued licenses. This policy effectively removed hundreds of smaller and mid-sized exporters from the global supply pipeline, the very participants who historically provided the flexible, price-sensitive supply that smoothed out short-term shortfalls. That flexible supply is gone. The remaining supply is rationed by sovereign license. Industrial buyers outside China, solar factories, semiconductor fabs, electric vehicle producers, face a structurally narrower pipeline that does not widen in response to price signals. It widens only in response to Beijing's policy decisions. That is the most durable supply constraint in this market, and it persists entirely independently of Iran, the Fed, or the dollar. The sentiment picture on February 22nd carries a specific signature that market professionals recognize as a transition marker. The point where a geopolitically driven rally graduates from tactical positioning into structural safe haven allocation. The defining signal, silver gained 5.62% on the week, while the US dollar was net positive. That combination is the fingerprint of genuine safe haven conviction. Analysts note that tactical currency traders buy silver when the dollar falls. That is a mechanical, reflexive trade with no fundamental commitment behind it. But when silver rises against a recovering dollar, the buyers are not currency traders. They are capital allocators who have made a portfolio decision. In the current risk environment, they need silver regardless of where the dollar trades. That is a qualitatively different class of buyer. And when that class of buyer enters, they do not exit at the first sign of dollar recovery. Sources note that the SCOTUS ruling combined with active US-Iran military positioning has reintroduced a geopolitical risk premium into precious metals. A risk premium, once embedded, does not dissolve until the underlying risk either materializes or is credibly and definitively resolved. The Iran situation, as of February 22nd, is neither materialized nor resolved. It is actively escalating on one dimension, carrier group deployment, while appearing to negotiate on another, Geneva talks. That dual-track uncertainty is the ideal environment for a sustained safe haven risk premium. It keeps the exit door closed for safe haven sellers and the entry door open for additional buyers. The Federal Reserve's internal division adds the monetary policy uncertainty layer. Reports confirm the FOMC January minutes revealed a three-way split. Members united on the current hold, but divided between those ready to cut if inflation eases, those cautioning against premature cuts, and those open to hiking if price pressures persist. That three-directional internal ambiguity is itself a silver bullish signal. Markets price certainty into asset values. When the institution responsible for monetary policy cannot communicate certainty about its own next move, investors move toward assets that require no institutional backstop. Physical silver, physical gold, tangible stores of value whose worth is not denominated in a policy decision. Reports confirm CME-tracked rate expectations currently price the first cut in June 2026, with approximately 60 basis points of total easing through year-end. Markets are also tracking that U.S. weekly jobless claims fell to 206,000, significantly stronger than the 225,000 estimate. A resilient labor market delays rate cuts. Delayed rate cuts support the dollar, yet silver closed above 82 anyway. The independence of silver's weekly gain from the rate cycle is the most important sentiment signal of the week. The Indian retail dimension adds the grassroots confirmation. Reports confirm that silver commodity-based ETFs in India advanced up to 2.62% on the week's rebound, with multiple major ETFs recording gains between 2.5 and 2.6%. When Indian retail investors, historically among the most price-sensitive precious metals allocators in the world, move into silver ETFs at these gain percentages, the safe haven demand has extended from institutional trading desks in New York and London all the way down to household savings portfolios in Mumbai and Delhi. Demand that broad does not evaporate at the first sign of geopolitical de-escalation. It recalibrates to the next entry point and re-enters. The floor of safe haven demand has widened in geographic scope this week. The sentiment map is clear. Institutional conviction, retail broadening, central bank ambiguity, and an unresolved military standoff. All four sentiment drivers point in the same direction. The risk premium is installed. The diamond hands are not moving. Now, let me compare silver's position this week against every major alternative asset class, because the relative performance data tells you exactly where the smart money is making its allocation decisions. Gold ended the week at $5,080.90, a gain of approximately 1% on the same dual catalyst week that drove silver 5.62%. The ratio is stark. Silver delivered more than 5 times gold's weekly gain. Both metals had access to the identical macro environment, the same Iran standoff, the same tariff chaos, the same Fed uncertainty. Silver ran faster, because silver has greater unresolved upside energy in its price relative to its supply situation. A market where deliverable registered inventory has been cut by more than half from its peak needs less external catalyst per dollar of price movement than a market where sovereign vaults are still accumulating and backstopping supply. Silver's supply situation is more acute. Its price response is proportionally more aggressive. The gold-to-silver ratio is consolidating below 64, as analysts note following the November 2025 breakdown from the long-term support level of 80. That breakdown, from 80 to below 64, was the technical trigger that launched silver's entire bull run from $50 to the January all-time high. Sources confirm that a further decline in the ratio from 64 signals additional upside for both metals, with silver leading. From 64 toward the historical compression zone of 40 to 50, silver outperforms gold by 20 to 30% on a relative basis before any absolute price move is included. The ratio compression trade is the highest conviction structural argument in precious metals right now. JP Morgan's 2026 silver average price target of $81 per ounce has already been exceeded as of February 22nd, according to market reports. Silver closed the week at $82.34, above the bank's full-year average with 10 months remaining. Analysts note that institutional price targets set by major banks represent the consensus view of professional modelers working with historical data. When a market exceeds those targets in February, it is not because the market is wrong. It is because the structural forces driving the market are more powerful than historical models anticipated. The China export licensing wall, the COMEX registered inventory drain, the dual carrier group deployment, none of these were in JP Morgan's base case model. They are all in the current market's price. The coming week's macro calendar sharpens the forward picture. Analysts confirm markets will watch U.S. producer price index data, consumer confidence readings, weekly jobless claims, and most critically, the People's Bank of China lending rate decision. If the PBOC cuts its prime lending rate, it signals monetary easing into China's industrial economy, which translates directly into accelerated silver consumption by Chinese manufacturers. Sources note that China has just reopened from the Lunar New Year holiday, meaning Chinese physical buying re-enters the market at exactly the moment the PBOC decision is released. The combination of a Chinese market reopening with a potential monetary stimulus signal is an ignition sequence for physical silver demand that the current price does not yet fully reflect. The honest contrarian argument must be engaged. The tariff reimposition at 15% globally could re-energize the dollar and create additional headwinds for dollar-priced commodities. If the dollar recovers convincingly above its pre-SCOTUS levels, silver could face a consolidation pull towards 77 to 78. That is the scenario the bears are betting on. Their bet depends on the dollar dominating both the Iran safe haven trade and the China demand reopening simultaneously. That is a high bar for the bears to clear in a week, where two carrier groups sit in the Arabian Sea. This is the battle plan for the week of February 23rd through February 28th. Precise, actionable, level by level. Position 1, your structural floor, $64. The February swing low, the right shoulder base, confirmed and uncontested. Every session that passes without a return to this level adds structural weight above it. This is the level that changes the thesis if broken. It will not be broken this week unless something dramatically and unexpectedly reverses every catalyst currently driving the market. Position 2, your tactical support, $77.34, the 20-period moving average, confirmed by technical analysis. Analysts note that a decisive close below this level would expose $72.16 next, followed by the 64 floor. The zone between 77 and 79 is your accumulation corridor if the market offers a pullback. Any dip into that zone during the PBOC announcement window or following a temporary Iran diplomatic development should be treated as a precision entry point, not a reason to doubt the structure. Position 3, your current launch pad, $82.34. The confirmed weekly close of February 22nd, 2026. This is the line in the sand. Above 82 on a weekly closing basis, the structure is bullish and the neckline approach is active. This is where diamond hands currently stand. This is where the battle plan is centered. Position 4, your first weekly target, $86. Reports confirm this as the next meaningful resistance cluster above current price. Watch the PBOC decision and the Iran news flow simultaneously. If the PBOC cuts rates and Iran escalates on the same session, silver could reach $86 intraday before most market participants have adjusted their positions. A sustained close above 86 removes the current resistance and opens a direct path toward 92. Position 5, your neckline activation zone, $92. This is where the inverse head and shoulders patterns measured move fires. Analysts confirm 92 as the next major resistance after 86, the outer neckline boundary. A weekly close above 92 confirms the pattern, activates the measured move projection, and shifts market psychology from recovery to new bull leg. This is the critical threshold. Everything below 92 is approach, everything above 92 is breakout. Position 6, your structural target, $104, the measured move completion zone. The distance from the 64 head to the 92 to 94 neckline, projected forward from the neckline. This number is fixed by the pattern's geometry. It does not change, it does not negotiate. When the neckline breaks, 104 becomes the objective. Two scenarios for the week ahead. Scenario 1, acceleration. The Iran military timeline arrives. PBOC cuts rates. Chinese buyers re-enter a market already climbing from 82. Silver breaks 86 in the first two sessions. 92 is tested before the week ends. Diamond hands holding from 77 or below are now sitting on 15+% gains from their entry. The measured move toward 104 is actively targeted. Scenario 2, consolidation. Iran diplomatic talks extend the timeline without resolution. PBOC holds rates steady. Silver consolidates between 79 and 85 as the market digests the week's moves. A pullback toward 77 to 78 is met with buying. Silver closes the week between 80 and 84. The structure holds. The approach to 86 resumes the following week. Every pullback in this scenario is a gift for anyone who missed the 72 entry. In both scenarios, the destination, 92 at the neckline, 104 at the measured move, is the same. The only debate is timing. Drop your answer in the comments. By the time the PBOC makes its decision next week and the Iran deadline fully expires, does silver close above 86 before March arrives? Make your call. This is the analyst. The third-day march is complete. The floor is at 82. The neckline is 11% away. The diamond hands do not blink. The weak hands already left. See you at 92. That's it for today's silver update. The market is setting up for a potential big move nowhere, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.